Hi, and welcome back to FX Open's weekly market update. Now, over the past few days, markets certainly were driven less by data and more by tensions in the Middle East. For active traders, this environment is quite familiar. Headlines move price, sentiment shifts rapidly, and volatility becomes the dominant theme. But as we move into the new week, the focus may shift slightly. Geopolitics, of course, remains a key risk. However, macro data could now become another important catalyst for directional moves. So let's break down what happened and what could move markets next. Unsurprisingly, over the past few days, the main trigger was a sharp escalation between the US and Iran. At one point, markets reacted to a clear ultimatum from Donald Trump: reopen the Strait of Hormuz or face potential strikes on energy infrastructure. Iran's response only added to the uncertainty, though. They were direct threats towards regional infrastructure. The situation seems to become more confusing rather than clearer. We saw reports of renewed strikes by Israel in Tehran, followed by a sudden pause in US action, and then claims of productive talks. Later, a 15-point peace plan was proposed by the White House. However, Iran signalled it had no intention of holding direct talks, even as a US proposal to end the war is under review by senior officials in Tehran. So from a market perspective, there was no real resolution, only shifting narratives. Oil initially moved lower on headlines suggesting there were negotiations, but that move lacked conviction, and markets are not fully pricing in de-escalation as yet. Equities showed the opposite reaction. Indices such as Euro Stoxx 50 and the FTSE 100 dropped to levels last seen in 2025 before rebounding, although the recovery was limited. This is not trend behaviour, it's uncertainty-driven price action. Looking at forecasts, analyst views remain divided. Karen Young from Columbia University's Center on Global Energy Policy expects oil prices to remain in the $80 to $100 range through 2027. At the same time, Oxford Economics projects Brent crude could reach around $110 to $114 per barrel in the second quarter. Now, according to CNBC, the oil market is currently in backwardation, meaning near-term contracts trade at a premium to later deliveries, signaling expectations of lower prices over time. As there seems to be no real progress in the US-Iran tensions, any forecast may materialise depending on future events. Okay, let's turn our attentions to the week ahead. And as we move into the new week, focus is going to shift at least partially towards macro data. First, US retail sales on the 1st of April at 3:30 GMT +3. Now let's take a look at some recent context. Retail sales were flat in December, following a 0.6% increase in November, while markets were expecting a 0.4% rise. On an annual basis, sales increased by 2.4%, which failed to keep pace with inflation at 2.7%. This pointed to weakening real consumer demand, particularly during the holiday period when activity is typically stronger and is a bit of a cause for concern. In January, retail sales declined by 0.2% month on month, confirming the loss of momentum. Now, the US dollar weakened significantly following that December data. If the upcoming release diverges from the January report, the US dollar may well react sharply, particularly given the current fragile market environment. Okay, and second up in terms of macro data for this week is the US non-farm payrolls and the unemployment rate on the 3rd of April at 3:30 p.m. GMT +3. Now, the latest data show clear signs of labour market deterioration. The US economy lost 92,000 jobs in February, the largest decline in 4 months, following a downward revision to January. At the same time, the unemployment rate rose to 4.4%. Following that release, the US dollar reacted in a mixed way, initially moving lower. And this time, volatility could be stronger, with markets already sensitive to growth risks. Any further deterioration, or in fact a surprise rebound, is likely to trigger a more decisive move in the US dollar. So, going into next week, markets are balancing two forces. On one side, a geopolitical risk that keeps volatility elevated. On the other, macro data that could start to define direction again. Analyst expectations still point to elevated oil prices and a fragile macro backdrop. It creates a market where short-term moves can diverge from the bigger picture. So don't forget your risk management techniques. But thanks for watching, and as ever, we wish you luck with your trading in the week ahead. Bye for now.